Hello and welcome to this session. I am your lecturer, Natalia Francois, and for this session, we are going to look at the financial market environment, Chapter 2. So our learning objectives for today is to understand the role that financial institutions play in managerial finance. We're going to contrast the functions of financial institutions and financial markets. We're going to describe the differences between capital markets and the money markets. And we're going to explain the root causes of the 2008 financial crisis and recession, and understand the major regulations and regulatory bodies that affect financial institutions and markets. And we're going to discuss business taxes and their importance in financial decisions. Now, financial institutions, firms, businesses, individuals, governments. We put our savings into financial institutions. Financial institutions, they act as the intermediary between us, individuals, banks, and businesses, where our money is used, the money that we put in the bank as savings. Either we get interest from it, very small, but our funds are then the bank loan our funds to the government, to businesses, and even to ourselves. So the financial institutions act as an intermediary for individuals, businesses, and governments. So the slide says it collects savings from individuals, businesses, and governments, and they use it to give loans and make investments in order to make a profit. So the bank doesn't have their own money. The money that they use to lend and to invest is our money, right? They act as the intermediary, so they form a very important part of our economy. Customers and net suppliers of funds, which would be all of us when we put our money into the bank, and businesses and governments are demander of funds. So when we want a loan, or the government wants a loan, you go to the financial institutions. Well, they sell bonds, securities to the financial institutions, right, who maybe package them as an investment package and sell to us or other firms as sell to us, so that they can give the money or loan the money to the government, and vice versa with corporations and individuals. So financial institutions, again, they play a very important role in our economy. They are required by the government to operate within established regulatory guidelines, because think about it. If there are no regulatory guidance and this institution is set up and call themselves a financial institution and tells you, come and bring your money in here into our bank or into our financial institution, and we would give you a percentage of your savings. We give you an interest of the money that you have in your bank, right? If there are no guidelines for these types of organizations, think about the chaos that could happen within our economies. As we go further, you would see the importance of how this regulation works in keeping our economy running smoothly, keeping interest rates at certain levels and keeping us from high inflation. So financial institutions, there are several types. We have commercial banks, and that's the banks that we regularly deal with, that we know about. Credit unions is a type of financial institution. Stock brokerage firms, these are firms that act as brokers. They are intermediary between the stock exchange, and we're going to further into these terms, stock exchange and the investor. We have asset management firms. Again, they also help with securities, bonds, and selling stocks to other corporations or to individuals themselves. So they act as intermediaries as well. We have insurance companies, which we are very familiar with. Our insurance companies are classified as a financial institution. Finance companies are classified as financial institutions. Building societies, right, where you have these cooperatives, they come together, bring money, and they have a goal, maybe it's a build housing project. They are considered financial institution. Retailers, some retailers, are considered financial institutions. So when you're putting your savings into financial institutions, this is the class. This is something that you need to ask the question, if you are offered an investment and you have to put your money into this investment. Remember, we said financial institutions are regulated, so they save us a whole lot. They save the economy on a whole. So you have to ask yourself, can this institution be classified as a financial institution? Now, financial institutions, they can be classified into two areas: commercial banks. And again, I said this is the banks that we are accustomed with. Their functions will be to accept deposits, provide credit facilities, right? Payment and withdrawal facilities. So they provide links and checks and these different instruments. Credit creation, interbanking transactions, bank to bank, agencies and utility services, so we can pay our water bills and electricity bills through the bank to these agencies. They act as references. Sometimes we need to go to the embassies and we need references. They're safe custodian of our money and several other services, right, they provide to us. So that's the basic provisions of a commercial bank. Investment banks now, they perform a kind of different function. While we have some commercial banks operating also as investment banks, investment banks, usually their goal is to raise capital. When I say raise capital, so let's say an organization wants to expand their operations, right? They want to have build 2 more factories and stock them with equipment. And this is costing around 10 million. How is the organization to get this money? Should they go directly to the commercial bank? Yes, they have that option, right? As firms, you have that option to go to the bank, or they can raise the capital. Right, and how we say raise the capital, so they go to an investment bank, and the investment bank, what you do, they sell shares on behalf of the company. So that's 2 ways to raise capital, right? Either by a loan or through issue of shares. So the investment bank acts as this intermediary to carry out this function for the company. To sell these shares, a share may be $1,000, and so they'll have to sell 100,000 shares to get 10 million. Portfolio management, the investment bank will help individuals as well as businesses organize their investment portfolio. When we say portfolio, means you can have a whole portfolio of investments. So your investment don't have to just be in the bank. It could be in real estate, it could be in contracts, it could be in gold and different things. So they organize that portfolio, so your portfolio is balanced, so you get any returns based on the objectives set by both of you, right? They conduct research, they conduct mergers and acquisitions. So they act more of a consulting role to firms, mostly firms, and business and small individuals. Now we have the central bank. Every economy, every country has a central bank. And why is that? Because we just said, the financial institutions, they act as the intermediary of the funds. All the money that belongs to your country, you look at it, and what does it have? What do it have on it? Right? The government of Trinidad and Tobago, it belongs to the Central Bank of Trinidad and Tobago. All the money belongs to the central bank. So the central bank has to regularize, has to oversee this money to make sure that there's no criminal activity within the economy. Make sure that everything is stable, interest rates can be reasonable, and the economy doesn't flop into high inflation, dollar loses value. So the function of the central bank, it is the bank of all banks. It's the monetary policy, so it sets the interest rates. It's the lender of last resort to the government. right, is the lender of the last resort again to commercial banks. And they ensure stability in the banking system. Without a central bank, we'll have chaos, right? They issue money, notes, and coins. So let me give you a little insight or further information. So the central bank is responsible for creating the money. They know how much money they have created, how much money is in circulation. Now, the commercial banks, investment banks, financial institutions, they all report to the central bank. So at the end of the day, their checks and balances, how much of this money, where is it in circulation, where it went, how much came into each bank, how much went out, right? So if you're running a business, and you have $100,000 made from sales, and there's no record of that $100,000 according to central bank, right? You didn't put that money in your bank account, so according to central bank, that money is missing out of the system, right? And you can cause some great problems by hoarding this money. So some people ask, why the police charging you for having money in your home, right? You have to be able to account for this money. If you go to deposit a certain amount of money into the bank, you also have to say where your sources of funds come, because they have to track to see, make sure they have the checks and balances of how much money is in circulation, and that people are not printing money, excess money that can crash the economy. Right, so the central bank has a very important purpose. So don't go and keep money under your mattress and say you're saving, right? You would be affecting the system. Your money needs to be put in a financial institution. Right, so in financial markets now, so there's a market, there's a market where we demand and supply goods, right? So we buy goods on the market, and there's also a supply of goods on the market. The same thing goes with financial markets. And why we have financial markets? Remember I said that firms, how do they raise capital? How does the economy grow? How does the government need money? They may need to borrow money, right? Or they need to get some money. If they don't borrow it, they need to get it from individuals, right? Either through share purchase, or they take it directly through the bank through loans. So there's this financial market created. So this kind of activities could take place. It's a market where suppliers and demanders of funds can meet. There are two types. There's the money market. When you hear money market, it's short-term debt and marketable securities. The international version is called euro currency market. So you may hear euro currency. Euro currency doesn't mean that it's European dollars. It's the example here is US company. It's a US company deposits US dollars in, let's say, FCB as a time deposit. So the deposits in the FCB. It's a US company, but the depositing in our local FCB with US dollars. FCB agrees to pay US deposits with a certain interest rate at a fixed time in the future, allowing FCB to invest that fund somewhere else during that period. So this is the firm, let's call them XYZ from the US, and they place their money in local FCB. Let's say it's $10 million, and they agree to an interest rate of 10% per year for the next 10 years, right? FCB now will take this US dollars and invest it, right? So it's euro currency, euro markets, but short term. So I shouldn't say 10 years, let's say 3 to 5 years, right? Then we have capital market. The capital market now is a long-term market, long-term debt, right? Or what we would classify them as bonds and equity investment. So when you hear bonds, it's debt, and equity will refer to stock, it's investment. So remember we said, right, firm can get the loans, can raise funds by borrowing from the bank, right? Or they can get it by raising money. So they can issue bonds. Usually government issue bonds. Later on we'll go to explain what a bond is, but in basic terms, a bond is a security, it's a debt instrument. So the government is trying to raise $1 million to do some building. I know a building, so let's say right, $10 million to a building, and they sell bonds with a face value of $1,000. So if we take 1 million and we divide it by 1,000, we should have 1,000 bonds. So they need to sell 1,000 bonds at a $1,000 each to raise that $1 million, right, to do whatever projects. And promises to pay a coupon rate, which means the interest rate, they promise to pay a 2% on the face value every year. So every year for the next 30 years, you get 2% on your $1,000, right? Which would be about $20 for the next 30 years. And at the end of 30 years, you get back your face value, which is 1,000. And we know stocks. So let's look at some key terms. Private placement would mean new securities sold directly to investors. So, right, so stocks. Again, if the company wants to raise money, then the government don't sell stocks, they sell bonds. So a large company or corporation wants to get money to do their development or to advance, do some investments, they would issue stock. If they issue stock for the first time they ever issue stock, they never issue stock before, it's called a first time, right? It's called in the primary, it's being sold in the primary market. If it's stocks that have been sold before, so I may have bought a stock before from Massey, and I want to sell it, I'll be selling it on the secondary market. Right, so private placement, new securities are sold directly to investors. So again, let's say the firm wants to raise $10 million. Instead of going on the stock exchange or the public placement, public market, they can go directly to an insurance company, let's say Sagicor, and tell them, we have this, we want to raise $10 million. And Sagicor takes your 10 million from policies that they have and they sell it or they give it to the large corporation in terms for interest rate, and those interest is applied to your policies, right? So that's the private placement. Public placement is when they go to the general public, and primary market is when they sell shares for the first time. Secondary is when you sell the shares that you already own, you're reselling it on the secondary market. Now, this video will show us the differences. I have this video here to show us the differences between the money market and the financial market, hopefully to make things clearer for you. Take a listen. Okay, so here you see some differences. You can go through it in your own time. Now I have another one explaining to you the money markets.
You may not be familiar with money markets, but you may have come across the term capital markets before. Capital markets are financial markets where longer-term capital is raised by companies and governments in the form of shares and bonds. In contrast, the money markets can be thought of as the market for shorter-term bonds. This is where companies and governments can meet their short-term borrowing needs. Money market instruments have a much shorter period of time between issue and maturity when compared to bonds, often just 3 months or less, but not exceeding a year. What are the main types of money market instruments? In the UK, there are 3 main types. The first type is known as a Treasury bill. They are normally issued weekly on behalf of the UK government. Treasury bills do not pay interest to the holder like a standard bond. Instead, investors pay less than the par value for them. This is known as being issued at a discount to par. Let's look at an example to see how this works. An investor pays £990 for a Treasury bill with a par value of £1,000, which has a maturity date of 3 months later. At the maturity date, the par value of the Treasury bill is paid back to the investor by the government. The investor's return is the £10 difference between what was initially paid by the investor and the amount received by the Treasury bill at maturity. The second type of money market instrument to know about is a certificate of deposit, or CDs for short. Put simply, they are tradable bank deposit accounts. They are issued by banks in return for deposited money and can be bought and sold in a similar way to shares. Let's take an example. Lloyds Banking Group might issue a CD to represent a deposit of £1 million from a customer, which is redeemable in 6 months. The customer will receive the £1 million back from the bank after 6 months, as well as an agreed amount of interest. If the customer needed their money back before the 6 months is up, they can sell the CD to another investor in the money market. The third type of instrument is a commercial paper, also known as CP. CPs are issued by large companies and do not pay interest in a similar way to Treasury bills. Companies and banks normally agree a program of issuing CPs well in advance. It's normally agreed that a particular value of CPs will be issued, and within that amount, the company will issue CPs with different maturity dates. Why are they attractive to investors? It often requires large sums of money to invest in money market instruments directly. Therefore, it tends to be institutional investors such as pension funds and insurance companies who buy them. Money market instruments are a relatively low-risk way to generate a return as the par value is preserved in the same way as bonds. This makes them popular during times of market uncertainty. As they are a short-term and less risky investment, the level of return for an investor tends to be once tax and inflation have been taken into account. Returns might only just be positive. Keywords: capital markets, money markets, Treasury bill, certificate of deposit, commercial paper.
Okay, I hope you learned some lessons from that so you can see the different types of instruments there are, if you didn't know, where you can invest your money short term or on the long term. Now, the capital market, we said, right, is a market that enables suppliers and demanders of long-term funds to make transactions. So we said that the government is looking for a long-term loan, bonds. So I'm reiterating the video. Bonds are long-term debt instruments used by businesses and governments to raise large sums of money, generally from a diverse group of lenders, right? They have a maturity date of 10 to 30 years and a face value of 1,000 that must be repaid at maturity. So you hear face value, or you would hear par value, as you heard in the video, but it just means that's the price you would pay for a bond, right? So if they're trying to raise $30,000 in bonds, they'll be selling 30 bonds, right? $3 million in bonds, they'll be selling, that's $300 in 300 bonds. Now, that's how they raise money. So how do the government borrow money? They issue bonds. And you You can get a bond, right, by going to your local central bank website and look and see the price of the bond, see the interest rate, well, they call it interest rate for a bond, coupon rate, right? So it pays, some bonds pay annually, some bonds pay semi-annually, so you can get the interest every year or every 6 months until the bond retires. And at the end of the bond period, you get back $1,000. Now, if the government is finding it hard, so like a time like now, persons are not willing to invest, right? But they need to raise some money. So they need to get the money out of individuals' hands into the government so that things can be done within the country. They will issue the bond, as the video says, at a discount, right? So it is encouraging investment. So what I mean at a discount, the face value or par value is $1,000, right? That's what you will get at the end of the maturity period. However, you would only pay, let's say, if it's sold at a discount, you would pay $900 for the bond. But you still get interest based on 1,000, and you still get $1,000 at the end of the period. So sometimes they sell at a discount to attract, right? Attract investors to put money into the accounts, or sometimes they sell at a premium. Um, you know, um, when things are better off and people have a lot of money or funds and they want to invest, the government can then sell the bond at a premium. So instead of $1,000, the bond might be $1,100, right? And normally, bonds with premium, they usually give you a higher interest rates because it's very competitive, right? Then we have common stocks, or equity. They are units of ownership or equity in a corporation firm. Shareholders receive dividend or capital appreciation. So when you go on the stock market and you buy a stock from a company, you automatically become a share owner. You own a unit of shares. So let's say the share is selling for $200 per share, right? And it's the same thing. The institution or the corporation wants to raise money. They sell shares. So they want to raise $100, they can sell 10 shares at $10. So if I buy a share or I buy 2 shares, I can buy how many shares I could afford, right, as an investment. How do I get a return from this? I get a return by dividend. So dividend comes like interest. It's paid to shareholders every year from the profits of the firm. So the firm is using this money to generate profit, and from the profit you get interest or capital appreciation. What I mean by capital appreciation, it means that I might buy the share for $10, but because this firm is doing so well, things happen, they issue new products and it's sold out, and the firm share price is now $100 and I paid $10 for it. I can sell that share, and so I have value, I have capital appreciation in my share. So I can either get by selling my share at appreciated value, or I can get money from dividends, right? And this is my investment I put in. So when you put in money into an investment, how is the investment paying you? Is it paying you dividend return? Is it paying you quarterly, half yearly, annually? What is the percentage return? And you'll also want to know, how is this business or how is this firm generating this profit, right? How is this firm generating this profit so that you can be paid? And making sure that they're not doing anything illegal with your money, because if they're doing anything illegal with your money, such as, let's say, buying drugs or selling children, sex trade, anything that's illegal, their money could be seized, and so your money could be seized if you invested in that organization. So ask your questions. Preferred stockholders are promised a fixed period. So we have common stock holders and we have preferred, right? You would have went through these terms in accounting. One, they are promised a fixed periodic dividend that must be paid prior to payment of any dividend. So the common stockholders, they are paid after the preferred, right? So in other words, preferred stocks are preference over common stock. So prefer, they always get dividend payment every year. So when you're buying a stock, find out if it's a preferred stock or common stock, so you know where you stand. Okay. The next slide tells us about these markets: broker market and dealer market. So I would have said before, brokers or dealers, they are intermediaries. They are people within between markets. Right? So broker markets, the buyer and the seller come together, and the trade takes place at this point. So as I said, I had a stock for $10 and it's now selling for $100. Do I need to go and look for somebody who needs to buy this? No, I go into the broker markets, right? They link me up to a buyer. So the seller A trades with seller B with the help of the broker, and it takes place on the floor of the stock exchange. When you hear New York Stock Exchange, right? You go online, you'd see all the stocks. You'll see the stocks, and they are facilitating the trade. Broker is facilitating the trade. So when I want to sell a stock, or my company wants to sell a stock or stocks, the broker makes the arrangement to find a buyer for the stock. The dealer market now, the buyer and the sellers, they are not brought together. Instead, a market maker executes the buy-sell order. This market is made up of an electronic trading platform where the market makers buys and sell the securities and the bid asks prices. So I will do a demonstration for you sometime of the market, of the electronic market trading, with the dealer market where trade takes place. So I can go online and issue my stock to be sold or to buy, right? And I come back the next morning and it was done, right? So on the electronic trading platform, the dealer market, they are the one who does the trade for me. So the bid price represents the highest price offered for the sale. Now the ask price represents the lowest price offered for the sale. Now let's look at a trading platform that I normally use with my finance classes. All right, so here we have a platform where I can trade stock. So I'm looking for the stock symbol to explain the buy and sell order, right? So I'm looking for Netflix. I'm looking Netflix. Transaction, I can either buy or sell, right? So I want to buy. I don't have any to sell. I want to buy, right? And it tells me the last price for it, any change. The price went down by 17 cents. That's a 0.3% difference. The volume has traded. The highest it went up to, the lowest it was. That's the price of it. So I can say how much I want. So it's 500 and something for one. Let's say I want share, or I want 10 shares. I can sell at the market value, which is 566, or I can set a limit order. I can tell my dealer market, my broker, that I would buy at 500 as a limit. and I make my order, right? So that is the simple process of buying, bidding, and asking at different prices, right? Or I could sell at different prices. That's a simple illustration. Now we have on the international capital markets. So we have these markets. We talk about the stock exchanges where you have the broker markets and the dealer markets. What about this euro dollar? When we said we want to put our foreign currency into another country, the euro market is the place where businesses or governments can tap into a larger market outside of their country to sell bonds. So Trinidad can sell bonds in TT dollars to traders outside of Trinidad. And foreign bonds is an international organization or government can sell bonds in the currency of the supplier of funds, that is, Trinidad company can sell bonds to US to an American business, right? In US dollars, right? If they need to raise US dollars, they can sell bonds in US dollars to an American business. On the international equity market now, it allows a company to sell a block of shares to others outside of their country, right? So the 2008, 2009, there was this big financial crisis. Let's look at this video and then we'll discuss some of the things that happened during this time. Right? So you get a better understanding of why these markets, there was a crash. Why these markets crashed? Demanders of funds, suppliers of funds, why it didn't all work well.
It all starts with this guy. This guy is Louis Ranieri. According to the movie The Big Short, this guy changed your life more than Michael Jordan, YouTube, and iPod put together. He was a born trader at Solomon Brothers when he came up with the idea of mortgage-backed securities, or MBS. This is your average person's mortgage. When he needs to buy a house, he approaches the lender. The lender gives him the money to buy the house in the form of a loan, and the house owner pays back the lender principal plus interest in the form of monthly repayments. This is a basic single house mortgage contract. Now if the house owner defaults, that is, he refuses to pay his monthly payment, the lender is at risk of not receiving his principal back. Now a big investment bank calls up the lender and buys up that contract. From the money received by the lender, it makes more loans to fund other house owners. Now if the house owner defaults on its monthly payments, the lender is not at the risk. The risk is transferred to the investment bank. Now the banks borrowed billions of dollars to purchase thousands of similar mortgage contracts, and they bundled them all together into mortgage-backed securities. This was a simple, easy, but a brilliant idea, as even if few homeowners default, payments from other houses would make sure that the intrinsic value of this security or contract is preserved. Now, the experts at the investment bank converted the existing MBS to a complicated financial instrument known as collateral debt obligation, or the infamous CDO. CDO has layers, or tranches as they were called. The low return branch bearing low risk profile, the moderate return branch with moderate risk profile, and the high return branch with the high risk profile. These layers were then sold off to investors according to their risk profile. This was a win-win situation, as this gave investors an asset to invest their money to grow, and for the banks, which made huge sums of money in commission fees without bearing any risk, since now if the house owners default, investors bore that risk. Now banks were making billions by repackaging mortgages and selling them to investors for commission fees. But after a certain point, banks ran out of homes to put in those bonds, as after all, there were only so many houses belonging to people with good enough income to afford them. So banks started putting more and more risky loans in these MBS. These loans had shady characteristics like variable interest rates, zero down payment, and no income verification. These type of loans were called subprime loans. Banks themselves borrowed huge sums of money to buy these risky loans, thereby increasing their leverage.
Leverage represents the amount of debt used to finance a firm's assets. The top 5 US investment banks increased their leverage rapidly from 2003 to 2007. By 2007, they were all at around 30x levels, meaning they had borrowed 30 times their working capital. As the number of risky loans went up, default rates increased. More and more people couldn't repay their mortgages. Initially, it wasn't a problem as house prices were doubling every few years, and hence the bank would recover the money by selling the homes that have been defaulted upon in the market. But as the default numbers skyrocketed through the roof, there were more and more houses in the market up to a point where supply exceeded the demand, and the house prices started plummeting. So initially house prices increased at fast pace as anyone could get a loan and purchase it. But when the default numbers went through the roof, there were more and more houses to be sold in the market than the buyers, and the house prices started decreasing. They decreased rapidly. Now, as there were no monthly repayments, there was no money coming into the CDOs, and thus for the investors who purchased these CDOs, they stopped receiving any returns. Investors stopped buying these CDOs and its demand went to zero. Now, the banks who were heavily invested in these assets began to experience a liquidity crisis. That is, they had no one to sell these CDOs to. They were basically sitting on worthless asset which they couldn't sell. Now these financial institutions, already over-leveraged, were suddenly in huge debt as they can't repay their own loan used to make these risky investments. The over-leverage was kind of a ticking bomb, which finally exploded. In fact, the total debt of top 5 US investment banks was over $4.1 trillion. That is about 30% of US nominal GDP for 2007. These factors I have talked about is to get you know the gist of what happened during 2007 and 2008. Like incorrect pricing of risk by the banks, increasing complexity of financial instruments like synthetic CDOs and CDO squad, deregulation under Alan Greenspan, and easy credit conditions.
Now, you can find several videos online that can tell you exactly what happened within this crisis. So I want you to really get a good understanding, right, as you go along your financial journey, right? Because this class is going to teach you a lot about personal finance, and making decisions in terms of buying, investing, right? So what happened in that time? You'll ask yourself, where was these regulations, right? They didn't have these kind of regulations in that time, so because of this, as we can see. So the banks giving mortgages, right? They're paying these mortgages, but how are they getting the money? They're borrowing the money from investors, right? And they're creating such a nice package. So maybe they're selling it to an insurance company. And who's buying into the insurance company? Who's putting money into the insurance company? Your pension fund, right? So your pension fund is maybe invested in someone's home. And let's say that person defaults, doesn't pay for their home. How would your pension fund get interest? You see what's happening? You see the cycle? So sometimes we have sympathy for persons when we say, the bank taking away their home and so and so and so. But it will affect the whole economy as a whole if the mortgager does not comply with their contract of paying these loans. Now you see what happened here. They got a little greedy, so they were selling houses that people really couldn't pay for, right? So what they call subprime loans. People didn't have proper job security or collateral, so the default was inevitable, right? So all these things happened that caused a financial crash of the economy in 2008, and many of these laws. So read your text. You'll see these laws that was put in place to avoid these kind of things from happening in place, right? These type of laws and what happened in this crisis will definitely come in your exam, so midterm. So we have a regulation of financial institutions. The central bank, again, we said regulates the financial institutions, right? They need to because we see what happened. They require all financial institutions to apply for a license to operate. So any financial institution that tells you come and invest, right? This is one of the questions you want to ask. Do you have a license to operate? The central bank, they regulate the interest rates, right? So an investment is giving you X amount of interest rates. Is this a regulated rate if they are registered? Right? They ensure that financial institutions take out depositors insurance. Now, depositors insurance, why is this important? Because if this financial institution decides, well, we're bellying up, or they have done illegal activity, and bank closed them down, right? So you may have had $30,000 in that investment. If this bank is regulated and has depositors insurance, your deposits would be insured. And so even though the company is closed down, they have the responsibility to pay you your $30,000. Your $30,000 is insured with central bank. Now, the regulation, they ensure that financial institutions keep a certain amount of funds on hand so that they would not lend out or invest all and not have to give suppliers if they request, right? So again, if you're looking for it, if you're in an investment and the company is not registered, these are some of the type of problems you can have, because here they're saying that they insure. So that's why I say at the end of the day, the financial institutions report to the bank how much they have out, how much they brought in, their checks and balances. Because if you have your money there, $30,000, and for whatever reason tomorrow you may have an emergency surgery, you should be able to go into your financial institution and get your investment, right? Even if it has a penalty for taking it out early, but you should be able to get it, right? So central bank ensures that financial institutions do give us this type of provision. They regulate the exchange rate of Trinidad and Tobago dollars and how much is provided to the financial institutions. So they know how much exchange rate they're going to give, right? And the same thing, their checks and balances, so that they will know if their false money is in the economy. It also works along with financial intelligence unit to monitor the operations of financial institutions with regards to possible criminal activities. So you can't just go and deposit $50,000 or $100,000 back. You have to declare, you have to show your sources of funds. It applies for companies as well. So this helps, again, keeping the criminal activities away. It also works along with Financial Services Ombudsman, who is an arbitrator for issues arising between financial institutions and customers. So if for whatever reason you're unable to get your money or there's some challenge with your money, right, you have the financial ombudsman within the central bank to make your query or to act on your behalf, right? Without going to a court of law, to act on your behalf to attend to your case. Trinidad and Tobago regulation of financial markets. Trinidad and Tobago Securities and Exchange Commission, they regulate the financial markets, the markets where these investment things are done. Stocks are traded, bonds are traded, even forex, foreign exchange is traded. The Security and Exchange Commission. In Trinidad and Tobago, we call it Trinidad and Tobago Securities Exchange Commission. Every economy, every country have a SEC, we call them, Securities and Exchange Commission. They regulate this market and what is happening. So all publicly traded companies must register with this company. So if a company says they're selling stocks, they should be registered with the Security and Exchange Commission before you can buy that stock. They monitor the performance of the publicly traded company to safeguard their investors, right? They monitor their performance, to see how they are going, to make sure that investors, they don't lose out on their investment. They review and approve regulated takeovers and amalgamations of companies, right? To make sure nothing is funny, haven't been done properly. They review the contents of the prospectus. Now, a prospectus, every investor get a prospectus. If you're going to invest anything in a company, even a small unit you're going to buy in a company, you want to know the prospectus of this company. The prospectus will give you what the company is about. Where are they spending this money? What type of business are they into? Right? How are they making income? It's going to tell you who are the chairman, who are the board of directors. These board of directors would have selected management. Who is the management running the company? Right? Is it a criminal? Right? Running the accounts department. This will give you all the information you need so that you can make an informed decision about your investments. Sometimes it will give you past financial statements so you can see this company is really profitable, right? This is proof that the company is doing well. It's not somebody coming and telling you, hey, well, you can get all this profit from this company. You ask, can I see a copy of the prospectus, right, before you make an investment into that company. The SEC, they take enforcement action against persons or companies that fail to comply because they're protecting the investors, right? They monitor the solvency of companies to protect the investors. So the company can't take your money and decide tomorrow, hey, I'm not in this anymore, close up shop and go on to a different land, Panama, right? They can't do that. They monitor these companies so that your investment will be protected. Now, companies pay business taxes, right? So if you're investing in a company, be sure that somewhere taxes will be paid, right? Either out of your investment, out of the business profits. And even for those of you who want to be entrepreneurs or are entrepreneurs, you have to pay government taxes. These are the taxes here for our local economy of Trinidad and Tobago. So as a business, you have to pay corporation tax, corporate tax. Ordinary business, except for banks, they pay 30%, right? That's 30% of your profits, right? Banking and petroleum companies, they pay 35 to 50. You allow deductions, right? So you pay the taxes on your profit. You allow certain deductions so your profit could be less. So we know depreciation, or we'll go through this. Depreciation, it's not an actual cash expense, but it can be deducted from your profits, right? So you pay less taxes. Interest rates, interest expense, again, if there's interest on loans, you allow that. If you make charitable contributions up to 15%, you allow that to reduce your profit, so you pay less tax. Operational expenses, staff training, you allow that. Capital gains are taxable, right? So the quantity made above the purchase of an asset, if you're purchasing a big asset, you're allowed a certain quantity that will be deducted from the tax that you need to pay, right? So take these things in mind. So when you're preparing your business and you're planning for next tax season, you see what expenses you can allow within your business. So if you're working with a corporation, so that the corporation can pay less taxes. Each corporation pay business levy. If income is more than $360 per year, the business is required to pay 0.6 of its gross revenue. Green fund levy, they pay 0.3% of gross revenue. Unemployment levy, only for petroleum companies are required to pay 5% of their profit. Now VAT, if income is more than $500,000 per year, the business is required to charge 12.5% on its products and its services. In summary, financial institutions bring net suppliers of funds and net demanders together to help translate the savings of individuals, businesses, and government into loans and other types of investments. Both financial institutions and financial markets help businesses raise the money that they need to fund new investment for growth. Financial institutions collect the savings of individuals and challenge those savings to borrowers such as businesses and governments. Financial management markets provide a forum in which savers and borrowers can transact business directly. In the money markets, we know savers who want a temporary place to deposit funds where they can earn interest interact with borrowers who have a short-term need for funds. Marketable securities, including treasury bills, commercial paper, and other instruments, are the primary securities traded in the money markets. In contrast, we have the capital markets as a forum in which savers and borrowers interact on a long-term basis. Firms issue either debt bonds or equity stocks securities in the capital markets. Once issued, the securities trade on security markets that are either broker markets or dealer markets. The financial crisis was caused by several factors related to investments in real estate. Financial institutions lowered their standard by lending to prospective homeowners, and institutions also invested heavily in mortgage-backed securities. Learn that term. When home prices fell and mortgage delinquencies rose, the value of the mortgage-backed securities held by banks plummeted, causing some banks to fail and many others to restrict the flow of credit to businesses. That in turn contributed to the severe recession in the United States and abroad. Now that's your lecture for today. That's your lecture for today. You are going over to eLearn and you're going to do the forum discussion for this unit as your assignment. See you next time.